Morning, everybody. This is Jim Bianco. Welcome to the conference call. Welcome, everybody. A couple of housekeeping items before we get started here. If anybody can hear me, just yell out that you can hear me so I make sure that everything's working properly. And then also, if you have any problems during the call, you could send Greg Blaha an email at gblaha@biancoresearch.com. Thank you. Somebody did say they can hear me. If one can, it's digital. Everybody can. Okay, let's detailing fiscal monetary stimulus. This was the title I wrote yesterday morning. I'm going to go to page 2. I put some bullet points on this. And this would be the title if I was doing it today, because I think yesterday, after a 34% decline in 6 weeks, the bear market rally might finally be in the offing. Today, the stock market finishes up today. This will be its first 2 consecutive day advance since the decline started on February 19th. But a 9% rally like we had yesterday, you might remember we had one before, I'll show that, a week ago. That's textbook bear market rally stuff. So I do think that we might have hit a temporary low. We're going to rally. But the hit to the economy is going to be historic. The unemployment rise is going to be something that we've never seen in American history. And so could the GDP fall as well, too. Unfortunately, the worst is still ahead of us. I'm not saying that it's over. But the latest on testing in the infection account will tell us how bad it's going to be. Tell me how bad the hospital system is going to be in 2 weeks. I'll tell you how much permanent damage we're going to be, because that's where I think, and I'll talk about when I get there, Wall Street's got this wrong. I know, we all know there's going to be a giant bottom in the second quarter, maybe into the third quarter, and then a V. But are we going all the way back to the old high? And the answer I think is no. How much short are we going to be of the old high? Tell me how bad the hospital system is. Tell me how bad we damage the psyche of the country. I'll tell you how much short we're going to come up with the old high. That's what we should be focusing on. It's obvious that we're not going to have 30% unemployment and then 60% unemployment. I hope it's obvious, but let's just go with that for right now. Q2 2020 earnings should be a loss. It's really how afraid of their shadow as Wall Street is. They needed Goldman Sachs to come out with 123% decline in second quarter earnings to kind of give everybody cover, to stop with the fantasies that, oh yeah, I'm going to take my number from an 8% gain to a 7.6% gain because we shut down the country. No, you're going to take it from an 8% gain to a 100% loss. Oh, I can't do that. Well, now that Goldman gave me cover, I can do that. That's kind of the way that the street works, and it's a little bit sad. Credit spreads have been seeing a record widening. I'll show some studies, show some charts there. And what I think is most interesting here is the Fed purchases of ETFs. I will go through the litany of what the Fed is doing. They are buying bond ETFs. The discounts in bond ETFs has disappeared only for the instruments the Fed's going to buy. Not a signaling device that the entire market can disappear with the premiums, only for what the Fed's going to buy, suggesting that the stresses are still there, if as bad as 2008, if not worse. The Fed ran, oh, I do have a cough. It's a normal cough. I get this every year. I get it when I'm talking. I apologize in advance for any coughing that I'm doing. The Fed ran through its entire 2008 crisis handbook in 3 weeks, and now we're at unlimited QE. What's interesting there is interest rates cannot fall. I think they should be at 0 if we were anywhere near a normal market. We're nowhere near 0 on interest rates right now. And on the other side, we might finally see a return of inflation. All right, let me dig into some of these as well too. All right, so here's a set of charts on page 3. These are drawdown charts. We had a 33.92% correction in 6 weeks. That is actually, if you look at it, the third worst correction in the last 46 years. Only 49% in 2000 and 56% in 2008 were worse. And we did this one in 6 weeks. Those others took well in excess of a year to eventually get there. I like to use the old window washer joke because I think it really applies right now. The window washer falls off the 10th floor scaffolding, and what does he say when he passes the 3rd floor? So far, so good. That's all we're doing. I mean, to be blunt about it, look, we're all at home, and let's just cut through the chase. To be blunt about it, we don't know how big a spot we're going to leave on the pavement when we hit it, because we haven't hit the pavement yet. Maybe we're 5 feet away from the pavement, and the spot will be a little bit smaller, or maybe we got 4 more stories to fall, and we're going to accelerate into hitting the pavement from here. But so when comparing to the 2008 decline, this is still a work in process. We don't know where it's going to end. This chart I found in Bloomberg, the 25% correction in March is the worst month since 1938. That even exceeds the month of October. Excuse me. That was this month of October 1987, which was the stock market crash. And the Russell 2000, astoundingly, is a 43% correction, nearly half its way to the stock market. This is the Russell 2000's worst, 3rd worst ever. Only the 59% correction in 08 and the 46% correction during the tech bust in 02 were worse. And we're just a couple of percent off of that. So the Russell is really seeing a lot of pain. Why? Because the FANG stocks are not in there. The only thing that seems to be holding up relatively well right now is the FANG stocks. If you're not Facebook, Apple, Amazon, Netflix, Google, maybe throw in Microsoft in there too, those 6 stocks. If you're not one of those 6 stocks, you're getting ripped to shreds. As well too. Let me talk about what happened yesterday. I put 2 different tables in here. These are exactly the same. The only difference is here's since World War II, here's since 1926. Astoundingly, if you look at all of these red parts in World War II, 8 days this month have made it into the list of the biggest move percentage days up or down since World War II. 8 this month. We have 5 more left this month. This has been a astounding month. I tweeted, take careful notes, because if you're fortunate enough to meet your adult grandkids, they're going to want to know what happened in March 2020. It's that historic what's going on. Yesterday was the 3rd biggest one-day advance on the S&P since the World War II. A couple of days in 08 were bigger. I know that the media wants to be more sensational and say that the Dow had its biggest advance in 87 years. That's true, but I prefer using the S&P. Go back in the history of the S&P, 5 months, 5 days this month have made the top 21 of all time. Yesterday was number 9. It was the most interesting rally, number 9, since the week ago, when we had almost a similar rally on the 13th of March as well too. If I go to the next chart, it shows you, well, let me back up here, these top 20 gains right here. So what I did on slide 5 is I plotted these top 20 gains. So you could see what happened over the next 100 days. On average, the market is down another 18%. 70% of the time, the market is lower. So what is, as I've pointed out, one of the more common asked questions I get all the time is, the market just did X. What happens next? And 99% of the time, I don't even bother answering it, because the answer is nothing significant. This is significant. When the market has one of these best days ever, it's in a bear market is when it happens. And that's why it continues to go lower. The exceptions were 1933. Things got so bad that in March of 33, the stock market was closed for 2 weeks while we completely restructured the banking system, the banking holiday of March of 33. And a bunch of these days are what happened afterwards. So basically, we wrote you off. The only time you want to buy one of the biggest up days ever is after you've been written off and you've lost all your money, basically, because we restructured the banking system. Then you want to get in, but of course you got no money to get back in. And then there's been a couple of other days, like the day after the 87 crash, but you fell 20% and it took you 100 days to get back 2.5% as well. So this has been a bear market, or as this one shows, another one I've pulled off of Bloomberg. Here is October of 08, when the Fed was doing all of the stuff they're doing now. The bottom was March of 09. The stock market fell another 40%. We were 40%. We had another 40% to go and another 6 months to go. So when we were doing the same things in October of 08 that we're doing now, we still had a lot more to go in terms of lower prices. So this is classic bear market stuff. And I think that we are probably close to having a bear market. Historic, what's happening here? Bullard said the unemployment rate can go to 30%. Here is the unemployment rate back to 1869. The all-time high print on the unemployment. This comes from various academic studies that have tried to reverse engineer it. The all-time high print is just under 22% at the height of the Great Depression. So we're looking at potentially having the highest unemployment rate ever recorded in American history as well. Year over year GDP, real GDP, again, academic studies that took it back to 1790. The worst declines that we've ever seen in real GDP have been about 10 to 12%. Now, this is on a calendar year real GDP for the whole year. We're looking at the second quarter annualized. That's the second quarter annualized. Goldman minus 24, Morgan Stanley minus 30, Capital Economics minus 40, Jim Bullard minus 50. You add that in with the expected rebound, and I'll talk about that in a second, and you're looking at 5 to 10% down. You're looking at 2020 coming in somewhere down in here to be among the worst economic years ever recorded. So this is going to be very bad. Initial claims is out tomorrow. The street estimate is 1.5 million. Here's the whole series for the 53 years of the series. And if the street estimate is at all accurate, that's what it's going to look like. Some of these estimates go as high as 4 million. So we'll see, but this is essentially what's going to happen with claims, some version of this tomorrow. So the economic damage is going to be tremendous. What we're going to see. I think what we need to focus on is not that the second quarter is going to be tremendously bad and millions of people are going to lose their jobs and we're going to print this insane unemployment rate. Yes, we know that the virus will pass. It will pass. It won't stay forever. And then we know we will go back to work. So there will be some kind of V rebound. The question really that no one wants to answer, and they're afraid to answer it, so they just talk about, V and we're going to get back to work, is what's the long-term damage? I've argued in these previous conference calls and others, there's permanent long-term damage to China. China, I don't think, is ever going to recover to their pre-crisis era, pre-virus. I call it pre-virus, to their pre-virus era. I don't think they're ever going to get there. Again, what is going to be the damage that we're going to have? You tell me how bad it's going to get in the next 2 weeks. 2 weeks ago, we had less than 1,000 cases. Today, we have over 50,000 cases. If our hospital system gets overrun, and if we see triaging in the hospitals where the doctors go into the waiting room and decides who gets a ventilator and lives and the rest don't, if we get to the point where they are in Italy, where they're just saying, are you over the age of 60? You don't get a ventilator. We're going to keep them for younger people. All this talk about opening in Easter will end. It will end. No one will want to do it. You can open the stores, and you can open the stores, and it'll be like China. China implored Apple, because Apple does whatever China asks them, open your stores. And they did. They opened their stores right away. Hey, that's getting better. Apple opened their stores. No customers for 2 weeks because everybody's afraid to go out and stuff. Is that what's going to happen with this if it gets really bad? The restaurants are going to reopen and no one's going to want to go to a crowded restaurant for a year? Or are we going to want to go to a crowded restaurant after a week? So I think it really comes down to the testing. We're testing. This comes from the COVID tracking project. It's a bunch of people trying to assemble the data on themselves. We're doing 65,000 tests a day. About 14% of them are coming in positive on average. As you can see, March 4th, we had 118 people March 4th that were positive. March 24th, 20 days later, nearly 52,000. So we've seen that. Now, what should come up happening is it takes you 9 or 10 days to get sick. It takes you another 6 days to get sick. It takes you 3 or 4 more days to deteriorate, and then you pass away. So the death rate, and I'm just commenting on what we've seen in other countries, the death rate should start moving up. The number of really sick people should start to get much worse. Even Trump has admitted that. New York State is the worst. Right now, 16,000 tests in New York State. They've got 11,000 or so, or 15,000 people that are sick in New York State. Just on March 13th, merely 12 days ago, they were still under 500, and now they're at 15,000. So you tell me how bad this is going to get. And yes, we'll have a V. I'll tell you how much we're going to come up short. So we're going to do both a V and an L. And so the L is to be determined. If it isn't as bad as I say, or we look more like South Korea than we do like Italy, then we'll have less of an L. If we look more like Italy than South Korea, we'll have a deeper L. That is to be determined, that there will be some kind of long-term damage. Slide 9, Goldman came out and put their second quarter S&P 500 earnings estimates at minus 123%. In other words, they're estimating a $10 loss, a loss for the entire quarter. There's only been one quarter where the S&P has lost money. That's the fourth quarter of 2008, all the way back to 1935, only the fourth quarter of 2008. And it looks like Goldman is estimating that the second quarter can be there too. Here's the street estimates for the first quarter. It was 10%, then it fell to about 2%, and then they went to a minus 3% over the next, during the crisis, and you can see how much they've been downgrading. Goldman's at a minus 123. The street average is at minus 3. Second quarter, the street average is at minus 4.7, up from plus 2. Goldman is at minus 123. I'm sorry, Goldman's at minus 15 for the second quarter. The street's at minus 3. It is a classic case that it seems like what the street has been is they're deathly afraid to talk about how things are really shaping up. They don't want to talk, so they need somebody like a Bullard or a Goldman or a Morgan to come out and just say minus 123. Okay, for the rest of you, it's now okay to go from plus 2 to minus 1 to minus 2 to minus 100. And I think that that's what's going to come next. And I think that the sheepishness, the inability of people to acknowledge what I think is happening is what's been a real problem. Credit spreads, this has been nothing short of astounding. This is investment grade spreads. You could see that they're in vertical rises. I've pointed out about this chart in the past. People have looked at this chart and thought that this was actually the y-axis, not realizing that that's actually what they've done. Yesterday, they were actually tightened for the first time since March 4th. Here's a longer term picture of where investment grade spreads are. Only the worst of 08. And this is in 6 weeks. That took almost 2 years to unfold, from June of 07 to October of 08, actually about 18 months to unfold on that, 17 months or so. But this has been 6 weeks. This has been astounding, the amount, but we've seen a little bit of a tightening there as well too. Just to run through some more of the charts, funding is becoming a real problem. This is from the FT, today's FT. It's in news clips as well too. $124 billion of credit lines have been drawn down since March 1st, with the largest being GM and Ford. Now, come on, we all know, as we look at these companies that are drawing down on their credit lines, they're all in trouble. They're not drawing down on their credit. Well, some of them are just, we better get the money just in case. But a lot of these companies are in trouble. So the amount of defaulting on these credit lines is going to be big. It's going to be big relative to history. The critical sources of funding for multinationals is freezing up. There's been no junk-related companies that have been able to issue public debt since the second week of March. You'll notice that this chart ends March 15th, so we don't have data for the week ending the 22nd, and we're working on the week ending the 29th right now. So funding has definitely been a real squeeze in this market as well too. And that shows up in the funding markets. The traditional TED spread, the 3-month LIBOR less 3-month bills, that has blown out to the highest level in 11 years as well. And you can see on the chart, LIBOR is heading up. Now, people have asked me, should we be using SOFR? SOFR is the secured overnight financing rate, secured. TED spread or LIBOR, That's supposed to be Treasuries, Eurodollars. That's where the word TED comes from. That's the way they used to trade it in the pit with the Eurodollar futures. The LIBOR is, if we can believe it, and I think we can because they've been burned so much, it's unsecured. So unsecured credit is rising while secured stuff like bills is falling, which is causing this spread to blow out. Commercial paper funding stress, 90-day commercial paper has been rising. It did dip down a little bit yesterday. 3-month overnight index swaps has been falling still, and so you've got this giant widening of it. And what's interesting here, and what's interesting with a lot of what we're seeing here, with a lot of this stuff, is, let me jump ahead to this here, and then I'll go back. The Fed has introduced all of these programs in the last 2 weeks. They have run the entire 2008 playbook in 3 weeks. I want to focus on the commercial paper funding facility, and I want to focus on the secondary market corp credit facility. The commercial paper funding facility has not started. The Fed announced it a week ago, and all they've done is they've had a bunch of lawyers talk to a bunch of bureaucrats about signing paperwork and getting indemnifications in place and all the legalese. It's taking them a week to just get the program set up. They're running through the same problem. They're running through the same problem with the second, buying corporate bonds and buying ETFs. They just announced BlackRock will run the program for them yesterday. Bunch of lawyers talking to a bunch of lawyers. That's what we do in a crisis. When we have a crisis, we immediately have to have a bunch of lawyers talk to a bunch of lawyers. And again, I'm at home, I don't care. They probably took the weekend off too because they're lawyers. Tells you what I think about lawyers as well. In that we can't get these things going. And so if I go back to my chart, we make the announcement here and things get progressively worse for the next week. And 1 million people get laid off because companies are being squeezed out of this. They got to do better than this. They have got to do better than this. If you're going to step up and support the market, support it. Don't step up and announce a bunch of lawyers are going to talk to a bunch of lawyers, and I'll get back to you in 8 to 10 days about when we're actually going to start this thing as well. And that's what's been going on, and that's what's happening with ETFs, and that's what's happening with credit. Another side note on this as well too, BlackRock's running the program. In 2008, PIMCO ran the program. In 2008, the top dog was active managers, and they picked the top active fixed income manager to run their program. In 2020, it's passive managers, and they picked the top passive manager to run their program. So it tells you a little bit about that as well too. The ETFs, I've talked about this discount with ETFs. ETFs are liquid. ETFs are where they trade on an exchange. Exchanges are where buyers and sellers meet in an electronic format, and there's more liquidity in a crisis. The fixed income markets are dealer markets. You have to go to the dealer. I won't go through the whole call from last week, yeah, it was last week, where I talked about the dealer balance sheets got full because everybody sold to the dealers, and then they couldn't make markets because they couldn't expand their balance sheet. The Fed offered $1 trillion in repo, but they can't lever themselves up because we've got 1 million rules to prevent that, because that was the problem in 2008. So then the Fed has been doing QE, and I'll talk about that more in a second, to drain their balance sheets to give them more ability. But what you've seen happen here is you saw these big discounts in the NAVs of ETFs as a signal that the market needed to go lower. Well, the Fed announced they're going to buy some ETFs, and they're going to buy the ETFs of investment that primarily own investment grade bonds. So BND, the Vanguard Total Bond Index, the premium disappeared. AGG, the premium disappeared. TLT, which is treasuries, the discount is still there. They're not buying those. LQD, which is all investment grade, popped up to one of the largest premiums, not a discount. It was at a discount here a couple days ago. Popped up to one of the largest premiums. What the Fed is buying is moving in the ETF market. What the Fed is not buying is not moving in the ETF market. My friends at Arbor Data Science, who had a terrific conference call yesterday, I tweeted it out. It's on the Arbor website. I encourage you to look at it if you're into a lot of the data science stuff. It's fascinating stuff they've done. They've pointed this out too. They look at here, this chart looks at the investment grade ETFs, the discount to the NAV. They broke it down by maturity. They've all rallied back to about zero, except for ultra short right now, but that's kind of an outlier as well. High yield, those discounts are not moving. They're not buying high yield. They are buying investment grade. In other words, what's moving in the ETF space? Only what the Fed is buying. The Fed wanted this to be a signal for everything to move, but it isn't. It shows you that the dysfunction is still there, but since we've got a printing press buyer in this stuff, those premiums go away. The printing press buyer is not buying this stuff, the high yield stuff, so those dysfunctions remain. We haven't gotten past this problem as well. So this is high yield. Again, the high yield looks like investment grade as well too. Second highest we've ever seen. There was a downtick in high yield yesterday for the first time since March 4th. I ran through that as well too. The Fed's balance sheet, just a couple more charts and then I'll give you the conclusions and I'll take some of the questions. Some of your questions are really good. The Fed's balance sheet has made a new all-time high just this last week at 4.67 trillion. The combined total of all the balance sheets made a new all-time high at 16.7 trillion over this last week. The estimates are the Fed's going to double their balance sheet to $9 trillion. The Fed is buying $625 billion a week of bonds. $625 billion a week of bonds. And it's unlimited. They'll keep going. If they did this for a year, they would own 2/3 of the Treasury market in 1 year. But we also know that the deficit is going to, the Fed is buying $625 billion worth of bonds, and I joked, maybe the Treasury is actually going to issue more than $625 billion worth of bonds from this moment forward to try and finance everything. We'll see where they go. But the Fed is set to buy $20 trillion worth of bonds at that pace in the next year. Now, will they go the whole next year? It's unlimited. They're not stopping. Who knows when they're going to stop? So there are credible estimates that this is going to go to 9 trillion as well. So if we look at the balance sheet as a percent of GDP, slide 18, the all-time high was 25%. It's jumped from 17.5 to 21. It should go, if you consider the contraction of GDP that's coming, somewhere between about 33% and 40% before it all ends. So the Fed, so this is going to scale right off the top of the page. The cumulative central banks collectively own 30% of all of their sovereign bond markets. That's probably going to go close to 40% in the next several months as well too. And that gets me, that gets me to this chart here. And I want to use this chart on slide 19 of yields, and I want to put you into my conclusions. I think we've got the first bounce in the first bear market rally. I bet we'll do 2 consecutive up days for the first time since the decline started, and we might rally back 50% or so, or as much as 50%. But I think that that's all we're going to do. Why? Again, I'm at home like you, so let me just put it out to you. If you're going to do unlimited QE and 7 programs that are estimated to be $4 trillion of stimulus and $2 trillion worth of stimulus is going to pass today, that's 25% of GDP. If I stick a cattle prod on the ass of the market, I may not fix it, but it's going to jump. And that's exactly what we've done, that's what we've done. We have jolted this market with a giant cattle prod, and it's going to jump, but that's all it's going to do. It's not going to be fixed. It's going to turn around and come back down. I can't find an example ever of a market that sold off this hard, this fast, and did not, at least after a bear market rally, retest or make a lower low. In 08, we went down another 40%. We jolted after everything the Fed did in October 08, and then we fell to a lower low, and then it was all over with. So I think this is only going to be a bear market rally. The Fed is unlimited buying $600 billion of treasuries. The Fed is offering the dealers unlimited repo to go out and make markets in treasuries. The 10-year yield has done what over that period? It's gone up. If this market was at all normal, the 10-year yield should have followed what the 3-month bill has done. The 3-month bill is at -4 basis points. The 10-year yield should have went negative if it was at all in normal. This market still remains dysfunctional. Again, my argument has been, what is happening with this virus is the most important event of this generation. It is the defining event of this generation up till now. Hopefully there won't be another bigger one coming. The market is looking at something it has never seen before. All those valuations and assumptions on the economy on January of 2020 ended in February. They are now, send them to the history department. They are history. There is a new set of valuations, a new economy, a new set of cultural norms. Maybe we get away with handshaking. So I've argued, why do you think the Japanese bow? You know, you go through enough of these pandemics and everybody starts bowing as well too. Same thing with the Indians in India. They don't touch each other when they greet each other. They do a form of clasping their hands and bowing as well. Go through enough pandemics, maybe the handshake goes away. I mean, cultural changes. The economy is going to be on a slower track. Deglobalization, de-risking, we're going to be at a slower track. If you think I'm wrong and we're going to bounce back to the old highs, you are betting that all of this will be forgotten. It will be a trivia question in 2 years. What was the name of that virus again back in March? Oh, CoV something or another. No, this is maybe that happens, but I think this is more likely that this is the defining event, and we're going to change and we're going to be at a much lower growth. So we've had a massive repricing of markets. Hey, everything's priced wrong. We need to go down. And the Fed has said this is causing tremendous economic stress. We've seen the stories. Neiman Marcus has already filed bankruptcy to restructure its debt. We've seen margin calls by EDF and Mann. We've seen Citi be stuck with a bunch of commercial mortgages. By the way, that's ground zero of the financial market stress is commercial mortgages. Hotels, malls, big office complexes, and the like, especially hotels, malls, they're not getting any revenue. They're not getting any revenue, and they're all highly levered. Why do you think Tom Barrack and the rest of them, even the Trump organization, is in deep trouble? If you've got a bunch of hotels with huge mortgages, your mortgage holders are going to pretty much own your properties here because you're not generating any income, and that's why they're begging for a bailout as well. 08 was residential. This is commercial right now, and it's New York City commercial. It's New York City commercial. So I've been watching for 10 years on CNBC every real estate guy that they bring up. Woody Johnson owns the Jets, and the guy who owns the Dolphins, his name, excuse me right now. Oh yeah, we got a Class A Manhattan real estate. Can't miss. The single worst thing to own right now is Class A Manhattan real estate because you're leveraged up to the hilt and it's generating you zero revenue, and you still got a mortgage payment every month to make. You're going to fall in arrears, and the mortgage holders are going to repossess your properties. So commercial mortgage is being destroyed in this market right now, and it's going along the way. So we've seen that Linda McMahon is doing a secondary offering of her WWE ownership at $38 a share because she's hurting right now as well too. Up and down the line, you've seen that pain, and you've seen $6 trillion of stimulus, $4 trillion from the Fed, $2 trillion from the bill they're going to pass today, and you sum it up, and yeah, we stuck a cattle prod in the market's ass. We're going to get a bear market rally, but that's all I think it's going to be. And then over the next 2 weeks, we're going to look to see what is going to be how bad this is going to get for the L. The reason that 10-year yields are going up because it knows that, as I argued before, for 33 years, I've been in this market for 33 years. For 33 years, people have said to me, crowding out, we're going to issue so much debt, yields are going to go up. And for 33 years, I said, no, that's never been the case. Now we're going to see issuance like you can't believe. We're going to think $1 trillion deficit is a balanced budget, what's coming next. And that's appropriate in some ways that it should be. That's why yields are going up. The 10-year, the 3-month is going down, and it's negative because everybody's hiding in cash. Remember, you pay 99.8 for a 3-month discount bill, and you get back 100. But you're so desperate to hide your money, you'll pay 100.1 or 0.03, in order to hide your money so you're paying above par. That's how you get a negative yield. It's just everybody, once they've liquidated, they're hiding in the, but this yield should be at 0, the 10-year, if we were negative, I mean, if we were normal, but it's going up because of huge supply. And the next, in my final chart, is inflation expectations. Inflation caps and floors, again, for my friends, Pete Forbes and Ben Breitholtz at Arbor Data Science, they're showing me the CPI caps and floors with a probability that CPI will be above 1%, had fallen a lot over the next 2 to 5 years, but it's starting to rebound. And over the long term, the 5-year and 10 and 30-year outlook, inflation expectations are heading higher. We're seeing that with the 5-year in the US, not yet in Europe. Let me also put it to you this way. All this stimulus is going to mean something else too. If you think the market's going to go back to all-time highs, this stimulus, if it does not produce eye-popping inflation and eye-popping interest rates, we shoot the 5-year back to 5 or 6%. If we forget this and go back to highs, I think that we're going to have inflation and 5 or 6% yields. If we can go back to the old highs, pump $6 trillion of stimulus into this economy and produce no inflation, we can delete the word inflation from the dictionary. Because if this doesn't produce inflation, nothing ever will. So no, inflation hedges, inflation bets now are not right. Because right now, we're all betting on deflation. We're all betting on minus 40% second quarter. We're all trying to assess the damage. Coming out of this, and there will be a V, this stimulus should produce inflation and it should produce higher yields. The bear market everybody's looking for. And your reward is going to be contracting multiples. So not only your earnings are going to come down, your multiples are going to come down. Why do you think the stock market sold off 43% on the Russell, 34% in 6 weeks on the S&P, which are historic by any measure, the speed of those declines? Because it's a massive repricing. We've got the wrong price. And this is a virus and there is no vaccine. There is no way to fix this. There is no red headline that I could put up on my Bloomberg in order to say, oh, the problem went away. In fourth quarter of 18, when the stock market fell 20%, it was fear the Fed was going to tighten too much, and Jay Powell could do away with it on January 4th with one sentence. We'll be patient and flexible. The Dow was up 1,000 that day, and we had the great year last year that we had in the stock market, 30% year, because it was man-made and it could be undone in one sentence. Speaking of red headlines, as I turned and looked here, Europe mulls suspending accounting rules to avoid virus hit banks. Read that to mean that, as I've argued, I think that the banking system is at its limit right now. It is sitting on fourth quarter of 08, make your mind bend losses. If we don't get a bear market rally now, and this peters out and we're at new lows next week and we keep going, then we got to start talking about financial crisis. Bernanke said we're not going to see a financial crisis. And I said yesterday, I agree with him now, as long as it stops now. But if we keep falling, then we're going to hit the pavement on my window washer joke, and there's going to be a big splat. And we're going to, maybe that, and I do think we're eventually going to fall. But if we can give everybody a 1-month reprieve before new lows, maybe we could come to reality. Guys, your bonus is gone. Now let's just work on whether or not you still have a job. Take these write-downs, restructure, move on. Quit trying to walk around going, it's just the flu, everybody's panicking, it will recover, we'll be okay, which is what I think they're doing. But the fact that Europe is going to try and hide their losses by suspending accounting rules, that it tells you it's bad. It's bad right now. We're not, we've had Ronin Capital in the US. We've had Ronin Capital in the US fail. It's a Chicago Mercantile Exchange firm. They were short volatility in the worst possible environment to be short volatility. But inflation will be on the backside of this, not for right now, because right now we're talking about contraction. And again, if we don't, after all this, we could delete the word, because if this doesn't produce inflation and high yields and rising yields, nothing will. And remember, rising yields means that your multiples are going to contract, on risk assets as well too. All right, let me stop there. Thank everybody. Let me take some of these good questions. First name only basis. I know who you are, and that's all that matters. Will stock buybacks become politically impossible for companies to receive bailouts? Yes, that is a given right now, that you're going to have to do away with your buyback if you receive any kind of bailout. Is the recent auction of governments by the Fed the end of the free markets forever? I hope not, because I do think what the Fed is doing, jumping into the corporate bond market, the ETF market, unlimited QE, is a partial nationalization of markets. And that reminds me, let me explain something. The Federal Reserve is by law cannot buy anything that's not guaranteed. Let me just go back to their balance sheet to put up there. They cannot buy anything that's not guaranteed by the federal government. So they are allowed to buy treasuries, mortgages, because Fannie and Freddie, implicit guarantee, agencies, same thing. You can make a strong case they could buy munis, and that it ends there. For them to buy corporates or ETFs or equities, they need a change of the Federal Reserve Act. Well, how did they do it then? Because they're not buying it. The Treasury Department is buying it. They're buying it in a special purpose vehicle that the Treasury will fund, and they're just acting as the Treasury's broker. So when Judy Shelton last month was being grilled in her Senate hearings, that everybody was really uncomfortable about, that she didn't see a big need to have a big separation between the administration and the central bank, and everybody's uncomfortable with it. Guess what? We just merged the central bank and the Treasury Department. As of Monday morning, Donald Trump became the head of the Federal Reserve, because the Federal Reserve is now the broker for the Treasury Department. The Treasury will decide when they're done buying corporate bonds, when they're done buying ETFs. That's Donald Trump. They're just their broker. The Treasury can also say, since you've got the special purpose vehicle set up and you're buying corporate bond ETFs, let's just keep going with equities. And let's just, instead of buying LQD and HYG, just start buying Amazon and Apple, and just buy SPY, the S&P 500 ETF as well too. Nothing to stop them from doing that. And that's very possible if we sink to further lows, because the Treasury will make that decision and the Fed will execute it as well. So the Fed, to end these programs, needs the Treasury to decide when these programs are going to end too. And if Trump gets reelected, when do you think he'll want to end this? Try never as well. So this could be in the long term a real problem for financial markets. As we've talked about, is the cure of fighting the virus, of shutting down the economy, worse than the disease of the virus? Is the cure of what the Fed is doing worse than the disease of illiquid markets? Over the short term, no. Over the long term, maybe. The only thing I would say is, I think what they need to do is, as soon as markets stabilize at down 30%, get out. Get out. Think about getting out this summer or so, or this fall, and I mean 100% out and never go back in the next 6 months. But what I'm afraid of is they're going to think, just like QE1 begat QE2, which begat Operation Twist, which begat QE3, which begat what we have now 13 years later. They're never getting out. They're going to think that they need to do this until we get back to the all-time highs. They will permanently distort markets in a bad way. If they need to do unlimited QE, look at the Japanese government bond market. It barely trades. Its volume is less than 10% of what it was 5 years ago. They have on-the-run issues that go whole days without trading. Why? Because there's one buyer. The buyer is the central bank, and the central bank sets the price. That's what yield curve control is. Yield curve control is, here is the price of the 10-year yield. It never, ever moves again. You can buy and sell it at this price all day long, but it doesn't move. So what's the point of buying and selling it if it never moves? That's the damage that we could do. So yeah, we've partially nationalized these markets, And I think by partially nationalizing these markets, we have to ask the question, is what the Fed doing this cure worse than the disease of the illiquidity that they're trying to stop? Nobody wants to have that. It's kind of like the question with the virus, right? Of course we have to shut down the economy. We can't let people die. Of course we have to have the Fed do this. We can't have financial firms, fail. Europe is now going to just change all the rules so they don't have to tell you how bad they are as well too. So yeah, it is. In my mind, it's a partial nationalization. We have merged the Fed with the Treasury. Trump, through Mnuchin, runs the Treasury. If Trump doesn't want, especially if he wins re-election, he doesn't want the Fed to stop buying. He doesn't. The Treasury will just announce, Jay, keep going. Jay, you keep going. Not your call, Jay. It's my call. You're my broker. You keep going. That's the risk that we face with this. And why would Trump say we'll keep going? Because we're only 20% from getting back to the all-time high. Yeah, maybe bids and offers have come and the volatility's gone away and we've readjusted, but you got to keep going and you got to ram this market back to new highs is what you've got to do. That could be Trump's thinking as well too. And if Steve Mnuchin tells him, no, you're wrong on that, well, I'll find another Treasury Secretary that will go and tell Jay Powell exactly what we're going to do with this program, and we're going to keep buying it. So that is a real risk as we move forward from here. Bill asked, do you think the market could get comfortable if the infection rates level off in areas outside of New York and London? Or do we need the financial hubs to flatten out before we could see stabilization? Two parts to that question. Yes, the market could get comfortable with the idea if it levels off. Let me use the US. In California, away from California, away from Illinois, Chicago, away from New Orleans, and away from New York. Those seem to be the big four hotspots, those big four cities. But in order to do that, we need to be able to get 75,000 tests done outside of California, Illinois, Louisiana, and New York. And then we could say, look, the other 46 states, they could stabilize and they can go back to sending their kids back to school. I read an interesting thing about the pandemic in 1918. We all know now that it came in two waves, and the second wave was the real killer. But during the second wave, it was devastating for Boston. It just knocked whole percentage points off of Boston's population. So many people died in Boston. But in St. Louis, that practiced quarantine, restrictions of traveling, and even some versions of social distancing in 1918 is barely noticeable in St. Louis. So you can have parts of the country, maybe St. Louis again, be barely noticeable. St. Louis could maybe send their kids back to school, maybe right after Easter, or that, businesses, all their businesses can stay open. As an example, I don't know that for sure about St. Louis, I'm just speaking illustratively. But if California, Chicago, New Orleans, and New York are weeks and weeks or a couple months away from doing that, the economy is still going to take a giant hit. And I think when you start talking about normalization of trade and travel, the entire planet's got to go to zero. Because look what's happened in Singapore, in Hong Kong, and Taiwan. They had it leveled off. They had it, and then they eased up a little bit on their restrictions, and some Taiwanese and Hong Kongers and Singaporeans from Europe came back because Europe's got such a big infection rate. Bam! In the last week, they produced the biggest one-day numbers ever, and they shut down their airport again, and they went right back. So the minute they backed off, they got a reinfection, because if it's not gone everywhere, you can't back off, because all you're doing is inviting it back in and restarting all over again. So yeah, if we isolate, we can have a St. Louis example all over the place, but it won't be New York, it won't be Chicago, it won't be California for a while until we get those numbers down as well too. But to get back to normal, we need it zero everywhere, or we need it zero, or we need to have heavy restrictions where it's not zero. Italy, you're sealed off. Spain, you are sealed off. France, you are sealed off. But the rest of you that don't have it, business as usual. But nobody from those countries is allowed to come to your country, or you're allowed to go to their country. We're not ready to do that just yet as well too. So those are where I think we need to go in order to see this thing fix itself. Some other questions here. Chris asks, last call you were in cash, market caught a bid yesterday. Are you picking away? No, because I think it's a bear market rally and I don't want to play the primary trend. I just think that we're going to see, usually a bear market rally is an absence of selling more than actually anybody buying. And I think that that's probably a better definition of what we're going to see as well too. So I'm just going to stay cash. And as I mentioned in the other call, I never went, I have mixed feelings about this. I never went, levered inverse ETF shorts because I thought to myself, I should do that. And then I thought, you know what? I'm betting on people dying and I just don't feel comfortable doing that. And the moral side of me says, you were very good and very smart to not do that. But then the financial greed side of me says, damn, you left a lot of money on the table. So, but I'm happy I did it. I'm happy I did not want to put myself in a position of rooting for people to die so that my position went up in money. But it is an unusual period, and that's just another one too. How much of a drawdown, Bill asks, how much of a drawdown in the growth and earnings is already priced in? I think a fairly good amount. I think way more than the street estimates. I think soon enough, we'll see the street estimates at minus 100%, meaning that soon enough, the street estimates, now that Goldman blessed it, they can say that the entire second quarter will be a loss as well. They should, because it's going to be a loss, especially for the few companies that will make money. They'll be swamped by the companies that will lose money, especially the financials that are going to lose just tons. They're stuffed with inventory that has fallen. Unless there's this massive record rebound by March 31st to pair some of those losses for the financials, they're going to have a fourth quarter of 08 kind of losses. They won't report them because we got rid of mark to market. But as I've also pointed out, the bank stock index is down by half from February 19th, or from the beginning of the year, to be more specific, half. We've halved all of the bank stocks because we know how bad it is for them. And they're going to report substantial losses. So yes, I think, minus 100 for the second quarter, a gigantic hit, maybe 50% down from last year for the whole year as well too, is what we're looking at. And now that Goldman blessed that, we'll see those forecasts go there. 21 will be a rebound. How much? Get back to my basic. You tell me how much triaging there's going to be in the hospitals. You tell me how long this is going to last. I'll tell you how much permanent damage we've done, or longer lasting damage, and how much we're going to depress 21 earnings. But everybody acts like, we're going to all forget this. And we're all going to go, man, I can't wait till they tell me I could get back to business in Manhattan, closing companies in the United States and shipping their jobs to China. That game is over forever. We're going to get back to business in closing our operations in China and shipping them back to the United States. And if you don't believe it and you want to fight it, we'll find somebody who will do it for you. Just like the anger with 08, no one was mad in October, November, December of 08. They got mad in 09 and 2010 when they created the Tea Party and Occupy Wall Street once it was over. Dealing with the crisis, everybody's focused on the crisis. Once the crisis passes, there's going to be hell to pay. And it's going to start with the origination of this virus. And that's going to be in China. It ain't going to be the United States. It's going to be Europe as well, too, because they've suffered just as bad. And the global supply chain will forever be changed, I think, from this. We're not going back. Now, it's not going to be eliminated. It's not going to zero. It's going to change. And it's going to take some time to change, but it will change, I think, as well, too. So, yes, the earnings numbers are priced in. The current estimates on Wall Street are just, they're just wrong. They're going to come down a ton, and we'll probably see a loss in the second quarter. Neil asks, down 18% from the point after the one-day gain, or 18% from the prior point in the one-day gain. What you're talking about here is, if I was to go back up, this was a comment I made yesterday. If I go back up to this table, I'm pointing out here that last week, oops, let's see now. Last week, the market had rallied 9.29%. And then over the next 6 days, from the 14th to the 23rd, which was day before yesterday, the S&P not only gave back that 9%, but fell 18% in total, was just annihilated. So what I was saying was, everybody's saying, wow, look at that rally we had yesterday. When was the last time we saw that? And the answer was last week. And what happened was the market got eviscerated right after that one-day rally. So keep that in mind, although this time I do think we might see a little bit more of a bear market rally. Bear market rally, lower lows to come. Worst is not behind us. So yes, this is what happens when you have big one-day gains. So that's what I meant by the 18%, is after that big rally last week, the stock market rallied big, the headlines were, whew, biggest rally ever, we're okay. We went straight down 18% for the next 6 days, right after that, which ended on Monday's low. And then we had the big update yesterday. Is this correct? How will the seasonal adjustments account for this event in the future, or will it be ignored? I assume you're meaning unemployment claims. And if you mean unemployment claims, yes, they're going to go up 3 million, and then they're going to take away about 7,000 for seasonal adjustments. That's what's going to happen. It's going to be not even the width of the line. The seasonal adjustments are set, and that you could go look them up. You know, it's add 30,000 here, minus 20,000 here, add 7,000 there. And if we have 2 million jump, okay, 2 million jump, and then you take away 7,000 for, I don't know, it's 7,000 yet, but it's going to be a rounding error. So seasonal adjustments won't matter when you see this kind of a jump. I assume that that's what you mean. Next question is, unemployment claims are spiking faster than ever. What do you think total claims will look like relative to prior recessions? Orders and orders of magnitude larger than then you're going to take the worst of 08, and you could say, is it going to be 100, 200, 300, or 400% worse? 1x, 2x, 3x, 4x, or 5x. I mean, that's pretty much the way you're going to have to look at this. And then when businesses open, it will go down by a record amount, but it ain't going to go back to 200,000. I don't think is what it is. It's going to stick, or not 200,000, but continuing claims are not going to go back to where they, anywhere close to where they are now. They're going to stick around for a while as well too. Charles asks, do you mean China will never get back to 6% growth, or its GDP capital markets have peaked? I think its GDP capital markets were peaked. China will lie. China will lie, and somebody credible just said to me that who's going to come out basically and say that China's been lying about their numbers and it's far worse in terms of the infection counts. I think China has no credibility on anything at all. But what I'm saying is, what I mean by it's peaking is, what is the engine of Chinese growth? Is that we close operations in the West to open them in China so they can employ more people to produce stuff to trade with us. That globalization game with China is over. Now, maybe we can make the case that we'll have some operations in Vietnam, we'll have some operations in India, we'll have some operations in, take your pick, Poland or something like that, just to spread it around, and we'll have some operations in the US. But we're not going to be doing the China thing anymore. As I've joked, January 15th, Trump had that big ceremony in the White House, and he signed the phase 1 of the trade deal and called it the most significant trade deal in American history. Donald, you're right, it was, and you signed it at noon on the 15th, and on the 16th, 12 hours later, China reported the first infection numbers, and it only lasted 12 hours, because then it all ended with the infection coming out of China, is where I think it will. So yeah, you know, initially we need China to ramp up to make car parts to get automobile manufacturers back running again. And then as soon as we're back running, we're going to start making plans to pull out of China, is what we're going to do. And you know, Tim Cook will say, no, we don't need to pull Foxconn out of China. And then the anger is going to build, and then is going to come the sanctions from the governments, because the populations are going to say, China put us through this, they need to be punished. And then the Tim Cooks of the world are going to say, before you permanently sanction them, let me yank out so that you don't have to do it by law, let us do it. So he'll eventually get slapped in the head, and he'll eventually have to come around to that as well too. Couple of more questions. What if China's numbers are not trustworthy? They're not trustworthy. Have they ever been trustworthy before? Why is no one on Wall Street talking about that? I think No one on Wall Street is talking about it because, again, Wall Street wants to spin positive stories. They want to say that China's numbers are good. The Wall Street Journal had an excellent story yesterday. How did China get their numbers down? Now, I think the shape of their numbers are right, that the infection rate is dramatically slower than it was, say, in the middle of February. It has to be. If it wasn't, 100% of the country would have been infected. But what they did was they just didn't quarantine. They essentially imprisoned people in their homes. And like I said, you're allowed out once for 2 hours to go to the grocery store every 7 days. You only got 2 days worth of food. Well, you're going on a diet. And if you come out, and when you're out and about, we have got police officers with those handheld thermometers that they put on your forehead, and they're randomly walking up to people. And if your temperature is over 101, you're thrown in a paddy wagon that second, and you're sent to a government quarantine center, and you're put there for 15 days. You're not allowed to call anybody. Maybe you're lucky and you got your phone and it's charged, and you could tell your family, I'll see you in 15 days. You're not allowed to get any, you're going to wear the same clothes. You're going to get one meal a day shoved under the door. And they're doing that to everybody. So that if you're sick, you better not leave the house, because if they do that to you, you're going to prison. That's how they got it under control. And that's the story was, and that's exactly what will never happen in the West. We will never go to those extremes. So the good news is we've got this under control. Well, I coughed 3 times during this call. I didn't see any police officer come in here and drag me into a government detention center. Short of that, we're not going to get it under control as fast as China. That's my take on this. I'm not arguing that this is going to be, the movie Contagion, but I am saying that what we have consistently done unfailingly has underestimated every step of this. Remember when we said it was going to be transitory, and we said it was going to be temporary, and it was going to be a V bottom, and and it was demand delayed, not demand destroyed. Every step of the way we have underestimated this. And I think we are continuing to do that as well. I think that the economy, if done properly, can recover to something that looks more like the 08 crisis, if not better than that, and nothing like the Great Depression. If we screw this up, it can be looking a little bit like the Great Depression. Could it be a problem picking a passive manager who may not understand the details of the market as much as an active manager? I think BlackRock understands it as well. I just think that BlackRock is going to be put in a very difficult position. I'm not saying that they can't handle it, just saying they're in a difficult position. The largest pricing service that's used on Wall Street, a separate Chinese walled pricing service, is BlackRock. BlackRock provides most of the fund managers with the raw prices used to fund your securities. BlackRock has always been wondering about, but a lot of these prices come from these ETFs, like HYG and stuff, and now they're running the Fed program too. So that department of BlackRock's running the Fed program. That department of BlackRock is running HYG. This department of BlackRock is setting prices, and none of them talk to each other. And I'll believe it that none of them talk to each other, but they're all under the same roof. They all have the same boss, Larry Fink. It poses a issue for BlackRock. It does not pose an outright conflict of interest unless they're not running it properly. So it's going to be interesting to see how this works with BlackRock as well too. Again, I'm not accusing them of anything. I'm just saying you've got a real compliance, issue that you have to make sure that you've lined up properly. That you're not having, some bleed through where, boy, HYG could really use X price. Can you guys over at the Fed make it happen? And can you guys in the pricing service go tell everybody that this is the prices that we want as well? And BlackRock does that now, and no one has accused them of that problem. But now, it's all under one roof, and it'll be very interesting to see how that works. Do you know the relative percentage amount of Treasuries, MBA, and corporate bonds and ETFs the Fed is currently buying? 75 billion a day of Treasuries, 50 billion a day of mortgages to be determined on corporates. The lawyers are talking to the lawyers who are talking to BlackRock's lawyers. They're working on that. And the same thing with commercial paper. The lawyers are talking to the lawyers, BlackRock's lawyers, to talk about how they're going to run the commercial paper program. They'll get back to you, but there will be some non-zero number. So that will go up as well too. Non-agency MBS liquidity crunch by adding non-agencies to their unlimited agency portfolio mortgage operations. I don't believe they can, because that falls under the rubric again of they're not guaranteed by the government. The corporate bond buying program, just like they said that they're going to do a Main Street lending program through the Small Business Administration, they've only put out a one-page fact sheet. They haven't gotten into the terms. I don't know if the non-agency MBS is defined as a corporate for their purposes yet. I think they're probably still trying to figure it out themselves. Follow up, BOJ, relative percentage of equities, government bonds, corporate bonds as well. Big thing with the BOJ is they own 66% of the ETF market. They are the ETF market, down from 80. They've been paring it back. They own 45% of the JGB market. I know those numbers because I actually looked them up this morning. I don't know if they own any corporates, and I don't think they own any equities. They own equities that they own equity ETFs. They will buy the equivalent of, they'll buy the Nikkei 225 ETF as well, but they don't own equities. See, the real problem with owning equities and the real problem with owning corporate bonds over time, I wrote a Bloomberg column about this last April, is these are ownership positions. You start buying equities, and let's say that the Fed goes nuts and they start buying equities. And I've said this before. Again, technically, who owns that? Technically, the Treasury owns it, and technically, the Fed is just their agent working for the Treasury. That's why they set up that special purpose vehicle, and they crouch it in words like the Treasury would take the first loss, because they're the equity portion. That's why they're going to take the first loss. So if you have this corporate bond position, and they got hundreds and hundreds of billions of bonds in there, say Biden wins, and let's say Nancy Pelosi says, we would like to have AOC appointed to a position with the Treasury overseeing the voting of proxies for these corporate bond positions to make sure that they're adhering to the Green New Deal. Or equity positions. AOC will work closely with the Treasury to make sure that the slate of candidates that they vote in the board agrees with the Green New Deal. That's the unbelievable slippery slope that you're walking into as well. Like I said, I wrote a column about last April. And that's why they decided to go with ETFs. All right, you can vote a slate of directors to run the ETF, but that's not running the management company. That's not, if you run iShares, you're not running, BlackRock, which is iShares. You're just running that iShares fund, and you're not running the companies underneath it. So that's the slippery slope that they really face, because there will be restructurings with some of this corporate debt, and then there will be having to have bondholders approve it, and the Fed will have to vote this some way. And they'll try and punt this to ISS, and then that will, but then the problem is there will be people in Congress saying ISS is institutional share services, which kind of gives you an unbiased evaluation of what they think is in the best interest of all the shareholders. Okay, whatever they say, we'll do. But Congress will say, hold the phone here. We have the ability to tell corporate America how to run their businesses, and we will take advantage of it any way we can. All right, a couple of more questions here. I'll take, how do you see the Federal Reserve assisting the REIT market that they are already having problems with meeting margin calls? Does that mean that the REIT market, does it what them for a sector as a whole? I don't know how they're going to do the REIT market. I know that the Fed wants to stay in liquid stuff, but I don't think that they want to stay. They don't want to. That's one of the reasons why I think they jumped to corporates and not munis. Why didn't they jump to munis? They have the authority for munis because it's not as liquid. And I think that they want to stay in that space as well. So I'll have to punt on that question. I'm not sure. 2008 did not have a retest of the low. We're having it now, aren't we? We did have a retest of the low. We're eventually having it now. But the problem evaporated 226 and 1.4 with Powell. Yes, Yeah, we are having a retest of the low now, but again, to fourth quarter of 18, December of 18 was man-made and was able to undo with one headline. We can undo this with one headline. CDC says vaccine found, inoculations to begin Monday. Oh man, watch how much we'd be up if they, but we all know we're not getting that headline. We know that headline's 18 months away. So we can't undo this with a headline. And so if we can't undo this with a headline, you slam down, you attempt a recovery, you have a retest. Fourth quarter of 18, slam down, call the whole thing off, then you recover. We can't call the whole thing off. That's why I think a retest is more likely, unless we find out that no, we look a lot like South Korea in the United States, even in New York City. New York City is not our Wuhan. New York City is more of our soul, is what it is. It's not that bad. Maybe then we don't need a retest. But if we start looking more like Milan in northern Italy, then we're going to have lower lows. Like I said, to be determined in the next couple of weeks. 2 weeks ago, I said the next 2 weeks are going to be critical. We went from less than 1,000 cases, actually less than 500, to over 50,000. Like I said, it takes you 9 days to get sick. It takes you 6 days to get bad. It takes you 3 days to be critical. Then you die. And I don't mean to diminish it. I'm just saying that's why Spain's death count was the highest ever. Italy reported the second highest death count yesterday. Although they've been dealing with this for weeks and weeks, you don't die 5 seconds after you get the disease. And that's why the death count is a giant lagging indicator with this. And we'll see it happen in the United States too. Everybody has said it, and we'll have to see how bad it gets and how much it affects our psyche, meaning how angry do we get at China? How much do we want to punish China? How much do we want to tear apart the globalization because China allowed this to happen to the rest of the world? No one is going to say that in a crisis, just like we didn't talk about crucifying the banks in the crisis, but in 2009 and 10, we created Occupy Wall Street and the Tea Party movement. That's when we got mad, is when we were past the crisis as well too. So I think we're going to see more of that. Did I read it incorrectly that the Fed is going to buy and hold 5 years and under IG corporate bonds and ETFs? Yes, they're going to buy under 5-year investment grade bonds. And they're going to buy ETFs that buy broad investment grade bonds as well too. So LQD, even though it owns longer than 5 years, they're going to buy that. But yes, but you know what? The door's open. Once the lawyers are done and BlackRock is buying and everything, it takes one call. It takes 5 minutes between a phone call from Powell or from Mnuchin to Powell. Hey Jay, tell BlackRock that we want them to buy out the 30 years. Thank you. Just text me back that message received. That's all it takes at that point when the program is set up. And if the markets are struggling, that they're going to do it. They're not going to they're doctors. They're like doctors with a sick patient. They're not going to say, look, I did all I can for you. So here's a painkiller. So just lay in this bed and die. They'll keep going. They will keep going. As they ran through the whole crisis handbook in 3 weeks. They will not, and then they went to unlimited QE. They will keep going. So yes, it is 5 years and under now when the lawyers get done and they can start. And if the market finishes its bear market rally and starts down again, no, they'll keep expanding it and expanding it. Munis, maybe all ETFs, including equity ETFs. I think they'll really hold off on equities because that's an ownership position. And like I said, that they really don't want to go towards as well too. Do I think that the 5-year inflation break-evens will continue to go higher over time? Yes, maybe not immediately. Because like I said, you're going to pump 25% of GDP in stimulus into this economy, 4 trillion from the Fed, 6 trillion, 2 trillion from Congress, 6 in total, and you're not going to get inflation, then you could delete the word from the dictionary. You'll get it, but you won't get it when you're going to be declining 40% in GDP and printing millions of people on initial claims week after week. You're not going to get it then, but eventually on the backside, when we get the recovery, you will get this stimulus pop, I think, with higher rates and higher inflation. And again, I'll repeat, if we don't, delete the word. Because if this doesn't do it, because this is orders and orders of magnitude bigger than 08. If this doesn't produce the inflation that everybody worried about in 2009, then nothing ever will. They might as well announce MMT at that point. If this doesn't produce inflation, let's just buy fiat, make Andrew Yang the president, and let's just start talking about $1,000 to everybody, and then we can work on $2,000 to everybody. Because if this doesn't produce, I'm not saying hyperinflation, I'm saying a bump up in inflation. If this doesn't do it, nothing will at that point. So yes, when it's over, not when we're in the process of dealing with the crisis. It won't do it then, but I think on the backside of it. Banks have been hamstrung by regulations. Wouldn't a better solution be to temporarily holiday these regulations? What would be the odds of that happening? Yeah, doing a holiday of the regulations would be a better way to go about doing it, but that requires all the regulators to agree to it, all of them to agree to it, and they're all afraid to it. What is the big holdup right now in Congress with the stimulus bill? That they want to make sure that rich people don't get bailed out. They want to make sure that it goes to the proper people. Why can't the Fed just call BlackRock and say, just start buying some stupid corporate bonds this afternoon? Just do it. Because the 08 experience means, no, while the world is on fire, burn a little longer while lawyers talk to bureaucrats to sign pieces of paper before we could tell them to turn on the fire hose. So that's why I think it's going to be very difficult. And as I mentioned on my call last week, somebody suggested, this is secondhand, I'm not saying this happened, if there's any press listening. Somebody suggested that the Fed says to some of the banks, just do it anyway. Just lever your balance sheet and just start buying and making markets and try and stabilize. Just break the rules. And they said, you know what? You told me to do that in 08. And I bought, and I'm using an example. And JP Morgan bought WAMU. And JP Morgan bought Bear Stearns because you asked them to. And they did a bad deal for themselves, but it was a good deal for the country and for the broader financial system. Then when everything calmed down, you called them banksters, and you find the hell out of all the Bear Stearns' bad practices and WAMU's bad practices, and that flowed through to JP Morgan, and they had to pay these gigantic fees. And Jamie Dimon said, if I had known what was coming, I would have never done it. So when you ask them, just do it for the betterment of no, I know what you did to me in 09, 010, 011. I'm not doing it again because this virus will end and you will crucify me on the backside of it. So that's why I think it's going to be slim that they just holiday a lot of these rules. Yes, Europe can suspend the accounting rules because it's one agency in Europe that can suspend accounting rules, but they can't suspend the capital rules. But I guess by default, they are suspending capital rules because if you allow them not to report properly, then they're still capitalized, I guess, as well, too. You know, we're not going to have two sets of books, I don't think. China contained COVID-19 within 2 months. Why can't the US and Europe? Again, because we can't go through the draconian measures that they went through. We are not going to have government-sponsored quarantines. We are not going to have 7-day quarantines, 3 hours out to buy food, and if you don't have enough, you're on a diet. We're not going to arrest people for leaving their house. We're not there. I don't know if we'll ever be there as well. Look, I'm in Chicago and we're in lockdown right now. I'm going to go to Subway at lunch and buy a sandwich, and I might go for a walk in the park. I'll stay within, no one will get within 6 feet, probably 20 feet of me when I go for the walk. To get some fresh air because it's in the mid-50s today. But that was not allowed in Wuhan for 2 months. It was not allowed for 2 months. And short of doing that, that's why I think it will take longer to do. And as far as what Fauci said yesterday, Manhattan is emptying out. Tens of thousands of people a day are leaving Manhattan. There was a story yesterday that Florida is considering putting a ban on flights from New York because all these people are coming. And they said, oh, if you just left Manhattan, assume everybody in Manhattan or New York City, to call it larger, so if you include Brooklyn and Queens and the rest, if you're from New York City, assume you've been exposed and please self-quarantine for 14 days. You think that those plane loads of people that are landing in Miami and Fort Lauderdale and Naples, Florida right now from JFK and LaGuardia are immediately going to go straight to their apartment or a condo or a hotel and not leave it for 14 days? Think that's going to happen? No, I don't think it's going to happen. They're going to do it for about 6 hours. They're going to say, I feel fine. I'm going to go outside and get some fresh air. Maybe I'll go down to the mall because it's still open down there. Do some window shopping or something like that. That's what's going to happen. And that's why I think, and like I said, it only takes 480,000 people could do it, 7 don't, and you still have a problem, is what it takes. That's why I think it's going to take longer to get rid of it. The good news, I think, would be the long-term solution is what's called the hammer and the dance. The hammer is shut it all down now, get the growth rate under control. The dance is learn to live with it. Everybody wear a mask, everybody social distance, everybody, if you don't feel good, stay at home. No one is going to think you're a slacker because you said, you know what, I don't feel so good. Maybe I should stay home for 2 weeks. And they're not going to roll their eyes like they work at some private equity firm and say, oh, you're just not tough enough. You would be, if you were tough enough, you'd come to work. No, we understand. Stay home. And then we can dance our way through having an economy and dealing with this at the same time. So the hammer and the dance is what we should do, but we're not showing either. We're not showing we want to hammer, and we're not showing that we really want to dance yet. Maybe if the death count rises, and I hate to be so morbid about it, but maybe that will scare everybody straight, and then we could do it. But that's the way out. Shut it down, get it under control, reopen, and then we all do the dance. And no one says boo when somebody says, I got to work at home because I don't feel good. Hey, we got it all set up to work at home right now. Yes, you stay home if you don't feel good. If you cough like I did 3 times, you stay home. Don't come here. But right now we have this tough guy attitude that everybody has to go to work sick. And if we continue with that tough guy attitude, we will never get over this. Thoughts on muni market longer term impact on recent auctions? They're buying variable rate debt obligations, VDROs. Again, the money market facility, which is not running yet either, the lawyers are talking yet, is meant to be that when the big redemptions come out of money markets, because companies have to pay mortgages, they have to pay salaries, people have to buy groceries, you don't have to strap the street with trying to dump all your short-term munis, short-term commercial paper and stuff. You could swap it for cash with the Fed in order to meet your redemptions. But beyond that, I think beyond the short-term stuff, the Fed, I don't think, is ready to go to munis because of the illiquidity. That's why they jumped to corporates. They could have gone to munis, I think, without even having to do these special purpose vehicles, but they want to try and stay away from them. I'm running really long here. I'm sorry, I kind of got wrapped up in answering a lot of these questions. But I'll keep answering them, just a couple of more, and then we'll go from there. With all these global policies, monetary and fiscal, what will be the impact on currency markets? If everyone is doing monetization of fiscal deficit, is the best way to look at it, look at the correct FX relative values? I think it's probably going to be dollar bullish than everything else because everybody's doing it. Everybody's doing it. And given the competitive devaluation or the competitive debasement, you're better off in the reserve currency than in some other currency. Gold would probably be, or something away from it would probably be a good proxy. But I think gold's problem is, the proper way to buy gold is you got to buy a bunch of gold coins and bury them in your basement. Nobody knows how to do that. It's hard. It's expensive. If you want to get away from a debasement in the financial system, buying GLD or gold futures is keeping your money in the financial system. You're not accomplishing what you're trying to do by buying gold. So I think that the problem with gold is there's too much paper for gold, and that's where it goes. But I do think short of that, I do think that the debasements argument would be if everybody's equally debasing, then the reserve currency is the place to be. Is this MMT just unnamed? Call it MMT Light or MMT V10, and we'll see how it goes. And if we get no inflation out of it, then why should we stop it? Why should we stop it? If they print money on behalf of the Treasury and buy on behalf of the Treasury, The Treasury puts a $10 million equity first loss position in there. Fed prints money and buys a bunch of corporate bonds for them, and prices go up and everybody's happy. Well, why stop? Why stop? If there's no inflation, if there's no consequence to it, why stop? So if there's no inflation, yeah, call this MMT version 1.0 or MMT light with more to come as well too. You've talked mainly about the US, but isn't the Eurozone heading to another crisis? Yes, I think the Eurozone is heading to another crisis. It is doing far less than the US to start from a weaker state. The north of Europe doesn't want to bail out the south. Yeah, that's true. All of that's true. The Eurozone has got a real crisis. It is bad in Italy, and it is bad in Spain, and it's probably going to get very bad in France because it's going to be very difficult to not be, because they've got borders with both of them as well too. And if the North is not perceived as helping, and I mean writing big checks, no one is mad in Italy now. No one is mad in Spain now because they're dealing with the crisis now. But when it's over with, they're going to demand retribution in some ways, and that might mean the end of the Eurozone or something, unless they step up. Now, there was a headline yesterday that Germany said it's time that we start bailing out Europe and helping Italy, helping Italy as well too, that German taxpayer money has to go to Italy. Yeah, if you want to keep the Eurozone, because what will happen is the anger will build, and if the politicians in Italy don't abide by that, they'll find radical politicians that'll make Salvini look like a conservative, and then they will go right to the European Parliament, and you will have 100 Nigel Farages, if you want to think of it in those terms, ripping the very part of the European Parliament apart is what you'll have, because because we were suffering. We're supposed to be the European community, and you didn't help in our time of need. So what good are you? That's what the attitude will be. Not now, because right now they're just dealing with the crisis and they're too focused on that. But if there isn't a perception that they're helping, that's what the risk is. And that's why I think they're going to have to step up for anything else. All right, let me end it there. Let me thank you all for joining us again. I appreciate your support and your kind words as well too. We'll put the transcript out as soon as we can. And we'll talk to you again in this format when we think it's appropriate. For all I know, that could be Friday or next week, or we'll see. Talk to you again later. Bye-bye.